Introduction to the Elliott Wave Principle. As an experienced trader and market analyst, I've always been fascinated by the intricacies of the financial markets. Over the years, I've explored various technical analysis methods, but one that has consistently piqued my interest is the Elliott Wave Principle. This unique approach to market analysis has been the subject of much debate and discussion, and I'm excited to share my insights with you in this comprehensive guide. The Elliott Wave Principle is a form of technical analysis that seeks to identify and interpret the repetitive wave-like patterns that occur in the financial markets. Developed by Ralph Nelson Elliott in the 1930s, this theory suggests that market movements are not random, but rather follow a specific sequence of waves that can be used to predict future market behavior. By understanding the underlying principles of the Elliott Wave Principle, traders and investors can gain a deeper understanding of market dynamics and potentially improve their decision-making processes. The history and origins of the Elliott Wave Theory. The Elliott Wave Principle has its roots in the work of Ralph Nelson Elliott, a professional accountant who lived during the Great Depression. In the 1930s, Elliott observed that the stock market did not move in a straight line, but rather in a series of waves. He theorized that these wave patterns were not random, but rather followed a specific set of rules and patterns that could be identified and analyzed. Elliott's work was largely inspired by the Fibonacci sequence, a mathematical sequence in which each number is the sum of the two preceding ones. He noticed that the Fibonacci ratios, such as the golden ratio, were often present in the wave patterns he observed in the financial markets. This discovery formed the foundation of the Elliott Wave Principle, which has since been expanded upon and refined by various analysts and researchers. Understanding the basic concepts of Elliott Wave. At the core of the Elliott Wave Principle is the idea that market movements can be divided into two main types of waves: impulse waves and corrective waves. Impulse waves are the primary direction of the market, while corrective waves are the counter-trend movements that occur within the larger trend. The five-wave pattern is the fundamental building block of the Elliott Wave Principle. This pattern consists of 1. Wave 1, the initial move in the direction of the trend. 2. Wave 2, a corrective wave that retraces a portion of Wave 1. 3. Wave 3, a strong, impulsive wave that surpasses the high-low of Wave 1. 4. Wave 4, a corrective wave that retraces a portion of Wave 3. 5. Wave 5, the final impulsive wave that completes the sequence. Corrective waves, on the other hand, are typically composed of three waves, known as the three-wave pattern. This pattern consists of 1. Wave A, the initial corrective wave. 2. Wave B, a countertrend wave that retraces a portion of Wave A. 3. Wave C, the final corrective wave that completes the pattern. Understanding these basic wave patterns is crucial for identifying and interpreting the Elliott Wave Principle in the financial markets. The five-wave pattern. Impulse waves are the primary direction of the market and are characterized by a five-wave pattern. These waves are labeled as waves 1, 2, 3, 4, and 5, and they follow a specific set of guidelines. 1. Wave 1 is the initial move in the direction of the trend. 1. This wave is often the most difficult to identify, as it can be easily mistaken for a corrective wave. 2. Wave 2 is a corrective wave that retraces a portion of Wave 1. 2. This wave typically retraces 38.2% to 61.8% of the preceding impulse wave. 3. Wave 3 is a strong, impulsive wave that surpasses the high-low of Wave 1. 3. This wave is often the longest and most powerful of the five-wave pattern. 4. Wave 4 is a corrective wave that retraces a portion of Wave 3. 4. This wave typically retraces 23.6% to 38.2% of the preceding impulse wave. 5. Wave 5 is the final impulsive wave that completes the sequence. 5. This wave often exhibits a sense of urgency and can be characterized by increased volume and volatility. Understanding the characteristics of each wave within the 5-wave pattern is crucial for identifying and interpreting the Elliott Wave Principle in the financial markets. The 3-wave pattern. Corrective waves. Corrective waves are the counter-trend movements that occur within the larger trend. These waves are typically composed of a 3-wave pattern, labeled as waves A, B, and C. Each wave within this pattern has its own unique characteristics. 1. Wave A is the initial corrective wave. 1. This wave often retraces a significant portion of the preceding impulse wave, typically 38.2% to 61.8%. 2. Wave B is a countertrend wave that retraces a portion of wave A. This wave can be difficult to identify, as it can take on various forms and can often be mistaken for the start of a new impulse wave. 3. Wave C is the final corrective wave that completes the pattern. 3. This wave is often the longest and most impulsive of the 3-wave pattern and can retrace up to 100% of the preceding impulse wave. Identifying and understanding the 3-wave pattern is essential for accurately interpreting the Elliott Wave Principle, as corrective waves can often be the source of confusion and misinterpretation for traders and investors. Guidelines for identifying Elliott wave patterns. Identifying Elliott wave patterns in the financial markets can be a challenging task, but there are several guidelines that can help traders and investors improve their accuracy. 1. Look for alternation. Corrective waves often alternate between different types of patterns, such as a zigzag followed by a flat or a triangle. 2. Identify wave relationships. Analyze the Fibonacci relationships between the various waves, such as the retracement levels and the relative lengths of the waves. 3. Observe wave characteristics. Pay attention to the characteristics of each wave, such as the degree of impulsiveness or corrective nature, the volume and volatility patterns, and the overall market sentiment. 4. Use multiple time frames. Analyze the wave patterns across multiple time frames to gain a more comprehensive understanding of the market's behavior. 5. Be flexible. The Elliott Wave Principle is not a rigid set of rules, but rather a flexible framework for interpreting market movements. 5. Be prepared to adjust your analysis as new information becomes available. By following these guidelines, traders and investors can improve their ability to identify and interpret Elliott wave patterns, which can ultimately lead to more informed and successful trading and investing decisions. Fibonacci ratios and Elliott wave analysis. The Elliott wave principle is closely tied to the Fibonacci sequence and the associated Fibonacci ratios. These mathematical relationships are often observed in the financial markets and play a crucial role in the analysis of Elliott wave patterns. The most commonly used Fibonacci ratios in Elliott wave analysis are 1. 23.6%, 2. 38.2%, 3. 61.8%, 4. 76.4%. These ratios are used to identify the potential retracement levels of corrective waves, as well as the relative lengths of the various waves within the 5-wave and 3-wave patterns. For example, the 38.2% and 61.8% Fibonacci retracement levels are often used to identify the targets for Wave 2 and Wave 4 within the 5-wave pattern. Similarly, the 23.6% and 38.2% Fibonacci retracement levels can be used to identify the potential targets for Wave A and Wave B within the 3-wave corrective pattern. By incorporating Fibonacci ratios into their Elliott wave analysis, traders and investors can gain a more nuanced understanding of market movements and improve their ability to identify potential support and resistance levels. Common mistakes to avoid in Elliott wave analysis. While the Elliott wave principle can be a powerful tool for market analysis, it is not without its challenges. There are several common mistakes that traders and investors should be aware of and strive to avoid. 1. Overconfidence. The Elliott wave principle is not a foolproof method, and it is important to maintain a healthy level of skepticism and flexibility in one's analysis. 2. Premature labeling. Correctly identifying the wave patterns can be challenging, and it is important to avoid labeling waves too early in the process. 3. Ignoring alternative counts. It is important to consider multiple possible wave counts and be open to adjusting one's analysis as new information becomes available. 4. Disregarding market fundamentals. While the Elliott Wave Principle is a purely technical analysis tool, it is important to consider the underlying market fundamentals as well. 5. Excessive reliance on Fibonacci ratios. While Fibonacci ratios are an important component of the Elliott Wave Principle, they should not be the sole basis for one's analysis. By being aware of these common pitfalls and striving to avoid them, traders and investors can improve their chances of successfully applying the Elliott Wave Principle in their market analysis and decision-making. Applying Elliott Wave Principle in trading and investing. The Elliott Wave Principle can be a valuable tool for traders and investors looking to gain a deeper understanding of market dynamics and make more informed decisions. By identifying and interpreting the wave patterns in the financial markets, individuals can potentially 1. Identify trend reversals. The 5-wave and 3-wave patterns can be used to identify potential trend reversals, allowing traders and investors to position themselves accordingly. 2. Establish risk management strategies. The Elliott Wave Principle can be used to define potential support and resistance levels, which can be used to establish effective risk management strategies. 3. Optimize entry and exit points. By understanding the characteristics of each wave within the 5-wave and 3-wave patterns, traders and investors can potentially identify optimal entry and exit points for their trades. 4. Improve market timing. The Elliott Wave Principle can be used to anticipate and time market movements, allowing traders and investors to position themselves more effectively. However, it is important to note that the Elliott Wave Principle is not a guaranteed path to success, and it should be used in conjunction with other technical and fundamental analysis tools to inform investment and trading decisions. Tools and resources for Elliott Wave analysis. There are a variety of tools and resources available to traders and investors interested in applying the Elliott Wave Principle to their market analysis. 1. Elliott Wave software. There are several software programs and online platforms that can assist with the identification and interpretation of Elliott Wave patterns, such as Elliott Wave International, ElliottWave.com, and TradeStation. 2. Educational resources. There are numerous books, articles, and online courses that provide in-depth explanations of the Elliott Wave Principle and its application in the financial markets. 3. Online communities. There are various online forums and discussion groups where traders and investors can share their experiences and insights on the Elliott Wave Principle. 4. Analyst reports. Many financial institutions and research firms publish regular reports that incorporate Elliott Wave analysis, which can be a valuable resource for traders and investors. By leveraging these tools and resources, traders and investors can deepen their understanding of the Elliott Wave Principle and potentially improve their market analysis and decision-making processes. Criticisms and controversies surrounding Elliott Wave Theory. While the Elliott Wave Principle has gained a significant following among traders and investors, it is not without its critics and controversies. Some of the main criticisms and controversies surrounding the theory include: 1. Subjectivity. The identification and interpretation of Elliott Wave patterns can be highly subjective, leading to disagreements among analysts and traders. 2. Lack of empirical evidence. Some critics argue that there is a lack of rigorous, empirical evidence to support the predictive power of the Elliott Wave Principle. 3. Confirmation bias. There is a concern that Elliott Wave analysts may be prone to confirmation bias, where they selectively interpret market data to fit their preferred wave count. 4. Complexity. The Elliott Wave Principle is considered by some to be overly complex and difficult to master, which can limit its practical application. 5. Hindsight bias. Critics argue that the Elliott Wave Principle can be used to rationalize past market movements, but may not be as effective in predicting future market behavior. Despite these criticisms, the Elliott Wave Principle continues to be a subject of interest and debate within the trading and investing community. As with any technical analysis tool, it is important to approach the Elliott Wave Principle with a critical and balanced perspective, and to use it in conjunction with other analysis methods to inform investment decisions. Conclusion. Benefits and limitations of Elliott Wave Theory. The Elliott Wave Principle is a unique and fascinating approach to market analysis that has captured the attention of traders and investors for decades. By identifying and interpreting the repetitive wave-like patterns that occur in the financial markets, the Elliott Wave Principle can provide valuable insights into market dynamics and potentially improve decision-making processes. However, it is important to recognize both the benefits and limitations of this technical analysis tool. On the positive side, the Elliott Wave Principle can help traders and investors. 1. Identify potential trend reversals and market turning points. 2. Establish effective risk management strategies. 3. Optimize entry and exit points for trades. 4. Improve market timing and positioning. On the other hand, the Elliott Wave Principle is not without its challenges, including 1. The subjective nature of wave identification and interpretation. 2. The lack of empirical evidence to support its predictive power. 3. The potential for confirmation bias and hindsight bias. 4. The complexity of the theory, which can make it difficult to master. As with any investment or trading strategy, it is essential to approach the Elliott Wave Principle with a critical and balanced perspective. By combining the insights of the Elliott Wave Principle with other technical and fundamental analysis tools, traders and investors can potentially enhance their understanding of market behavior and make more informed decisions. If you're interested in learning more about the Elliott Wave Principle and how it can be applied to your trading or investing strategies, I encourage you to explore the resources and tools mentioned in this article. Feel free to reach out to me if you have any questions or would like to discuss the topic further. I'm always happy to share my knowledge and insights to help fellow traders and investors succeed in the financial markets.